Let's talk about, I want to touch on uncapped indexes just for a minute, really quick, because we're talking about companies lowering cap rates, they're writing it off as a marketing expense and all that. And of course, one of the things that I get pushback on from IUL agents is, well, you just do an uncapped S&P 500 index. And again, they make it sound like that's just the solution to all the problems. Let me know if I'm on the right track with this. So it's almost just like a cap rate. Obviously, it's uncapped, but I'm talking about like in the beginning, right? So you have this uncapped S&P 500 index that has 100% participation rate. Well, the first question that comes to mind is that 100% participation rate guaranteed for the life of the contract? Which it probably isn't.
Well, you'd have to look at each contract individually, each illustration, and see what the guarantee participation rates are. Typically, it's not. So there's two things in uncapped illustrations that come in play. Three things ultimately. One is the participation rates. And first of all, if I'm going to do any uncapped indexes, and and this is just a warning for anybody, never do an uncapped index that is a proprietary index, because it's just smoke and mirrors, and they've done these like completely insane.
I want to touch on that after this with the lawsuits going on. But for sure. So avoid the proprietary volatility controlled index at all costs.
100%. Just do the S&P 500 first of all. So it's an actual back tested on an actual index, and it's got the history, and it's stable, and it's got the the results. And that the options market and pricing is going to be predictable, right? There's a history and a trend that you could follow to be actually understand what you're doing if you want to go and learn about the options. So there's that. Secondly, you got to take into account, and I'll say to that is that based on all those factors, that will maneuver the participation rate. That's one thing to consider.
Right.
Secondly, on no capped indexes, there's a thing called a spread charge. So even with 100% participation rate, then you have to check and see what is the spread charge. Is there a spread charge? And a lot of times what you'll see is they'll offer a higher participation rate, but then they'll have a higher spread charge. Maybe the spread charge is 5, maybe it's 10, maybe it's 7. But the spread charge basically says is whatever you see for a spread charge, it means the first whatever percent. So for instance, if the spread charge is 5, it means the first 5% that the index does, you're not going to participate in. They keep it. That is the cost of buying that option, right? They're saying up to that price, you're going to get nothing. And if it goes higher, you keep everything above that. Now, a lot of times, and this nationwide policy I was mentioning earlier had a spread charge of 5% when it was sold, and a cap, meaning a guarantee of 15% on that spread charge. And so that seems way higher, meaning if they changed it to 15%, that means the first 15% return in the S&P 500, you would not be able to participate in. If the market did 25% return, you'd actually get a 10% return, which is just atrocious, right? Like if you think about it that, no chance.
So it started at 5. What was it when you ran the in-force illustration?
11.
Oh my God, dude.
6 years later, it was 11%. So that means that person who was participating in this uncapped index, they thought they were doing amazing. They had to pay. They don't participate in any of the market gains up to 11%. They only start participating above 11%.
Which goes real quick. I want to touch on that real quick, Chris. Which because you mentioned earlier that in some years, particularly when we're in an unprecedented bull market, IUL can have some really, really good years. So if the argument could be like if the market went up 26%, I think it did last year or the year before, or something like that. And even with an 11% spread charge, I still earned, what is that, 15%, whatever?
Yeah, I mean,
that would be the argument. But how many times is the market going to do that as well? So now what you're doing is you're promoting IUL based on the market going up 26%.
Yeah,
that is not going to happen on a long-term basis. So you can have some good years. But if those spread charges rise and they stay high, and then the market does 15%, you've got 4 in that particular case, right?
For sure.
That's insane.
100%. And the other element to think about here, so that the first was participation rates, the second was spread charges. The next one is what we call the no risk rate, which is essentially the 10-year bond rate, right? Like if you look at it, Bobby Samuelson talks about this a lot. right now it's about 5.5%. So no matter what, on any policy, the no risk rate is the rate that the insurance company uses to protect themselves on these uncapped indexes. And so no matter what, that 5.5%, even on when you do something that doesn't have a spread charge, that no risk rate is involved all the time. It's always there.
Is that with every policy, or is every company different?
Every policy, if you got 100% participation rate, that 5.5% in this situation, whatever the 10-year bond rate typically is, that's kind of the metric that they use to measure it. That no risk rate is always there, even on with no spread charge. If they just are doing the participation rate policies, that no risk rate is there.
Is that specifically for uncapped indexes?
Correct.
Gotcha. Okay.
Yeah. Because they gotta remember there's no free lunches, and we got to figure out how are they pricing this stuff in, and these cap rates, they could buy higher cap rates, right? If they wanted to give you a better return. But the question is, where's the happy medium on the cost of that cap rate? And based on what the general fund performance is and what their budget is, they got to dictate, can they afford to buy that? That's how the cap rates go up and down effectively. And then it goes back to the marketing expense conversation that we had. They know they can't buy 11% cap rates right now, but they're marketing a lot of times at 11%, even though they know that they could really only afford a 7%. And so what they say is that 4% difference, they're just going to write off. Or maybe if it's an 8% that they can buy that they know, they're going to write off a 3% difference when they have those losses. And that's how they make it acceptable in their minds to do it, because it's a wildly profitable product that they control and that they have very little risk on. That's another reason, not to go on a side tangent, but that's one of the reasons that the underwriting for IUL is much more flexible and easy than whole life insurance, because of the fact that they know they can control their risk. If you think about the fact that all life insurance comes and it's underwritten, and the insurance company has to assign the risk of your life and lifestyle and healthy habits and all the things that go into human life value and risk. And with IUL, if they know that they can control all the variables on the back end, and whole life, they know that once you sign on the dotted line, they're contractually obligated to meet their obligations and your guarantees. Well, then of course it's going to be easier to be underwritten for an IUL than a whole life policy. The worst thing that happens in this business is agents work with clients because their underwriting is easier. They're trying to just make it as easy to get through and make the commission. I want to make it so I want the underwriting to be hard, because I want to work with a company that's actually committed to the stability and solvency and doing good business, so they can actually be there for the participating members of the company, which are the policy holders. So,
and not just taking advantage of the fact that they have all these different levers that they can pull, right?
Exactly.
And where they're actually committed to the policyholder long term, and not to mention that if you are healthy, then and for the most part, I mean, you don't have to be super healthy, but if you could get a good rating, you want to go through underwriting, because if you don't, now you're subsidizing all the people that
100%.
are not healthy that are getting approved, because it's so much
100%.
easier, because they can pull all the levers. So you actually end up paying more for the same type of policy that you could have gotten elsewhere. Like, it's asinine.
100%. So
that's a whole other rant that I did a video.
Sorry, I had to go on that little tangent for a minute.
No, you're good. There's so many things. There's so many problems. With so many things involved with IUL. It's like so far from being a simple product the way that it's sold. Like there's so many things you have to consider. That's why there's so many rants about it.
But the good news is that I've got a book coming out that'll solve all those questions for you. And
it was really good. I can't wait. Once that is launched, we'll have links down below, guys. Make sure you get that. Can people pre-order it right now?
I'm working on getting that page up. So when do you think this video is going to come out?
Probably today or tomorrow.
Oh, geez, you've turned this stuff around, buddy.
Yeah, man.
Give it a week.
Yeah, whenever it's ready, just send it to me, and I'll come back and edit the description. But yeah, I want everybody.
So I'll tell you what. If you're watching this video now and you're seeing us talk about this, and the link isn't there, I'll say come back in a week, and it'll be there. So come and check it out. Get
on my newsletter, get my free masterclasses and stuff like that, and I'll send it out.
Perfect. Love it.
What I want to finish up with really quick, Chris, is I did want to touch on the IUL losses, just because it's been like a really wild year for IUL, and you alluded to some of this earlier about the volatility controlled indexes, proprietary indexes, and I'm sure you're probably not able to talk about it much, but you've been a consultant, I think, or something like. Can you?
Yeah, we're doing.
Okay. That's probably the extent that you can talk about it, right?
Yeah. Well, I'll say this. Here's what I could say. I can't get into any specific cases. I can't get into any companies. I can't get into any, details about policies and so forth, because I'm not allowed to comment on ongoing situations.
Yeah.
What I can say from a high level perspective is this, is that due to the nature of my channel and the work that I do in helping people evaluate their policies, and I have a thing called rescuemyiul.com, where people go and they submit enforced illustrations with original illustrations. We do policy evaluations, and we see these things. I get between 3 and 5 submissions a day on that website.
Wow.
And which is crazy. If that doesn't tell you like what's going on in this space and where people are after they buy these IULs, then,
yeah,
I don't know what to tell you, but here's the deal. I get this stuff. And so it got to the point where I was like, oh my gosh, like some of these people are so screwed, quite frankly, because they put so much good money after bad, and they're like wondering, what can I do? Because it's been misrepresented and mischaracterized about what this product's going to do for me. And they've been putting their financial future on the line, pouring it into these products. I've got some people that are putting multiple 6 figures into these IULs for 4 or 5 years each. Like we got a guy that came through is putting $300,000 a year into an IUL for 5 years. And now 5 years later, he literally has a surrender charge, and the growth has been lower than it was illustrated at. And I mean, he's lost $800,000 out of his 1.5 million that he's put in.
That's wild.
And it's insane. It's insane. And so when you look at his original illustration comparatively, he was supposed to have almost the 1.5 million in there right now,
right.
That, including the surrender charges and all that taken into consideration. So it's a wild world in this space. And so I just got to the point where I was like, man, I need to do something about this. If I can't help them, there's got to be a legal ramification, some legal recourse for these people. And so I partnered up with a litigation attorney. And now when people reach out to me, I literally just funnel them over there. The dynamic of my relationship with him is, I'm doing evaluations, and, I help analyze and consult and help break down policies as a product expert, so to speak. And it's been a really fun relationship, because I know it's making a difference. It's actually helping people unwind these things that are potentially going to blow their entire financial life up. So.
Right. I would imagine that is very, very rewarding, because it's really sad when somebody comes to you, wants help, needs help, their situation, their finances has just been crushed by this thing, and there's really nothing you can do for them other than some type of potential legal ramification, which not everybody probably qualifies for that either. And so when you're able to help somebody on that, it's probably very rewarding.
Yeah, I mean that's it, right? Is just figuring out what's the best path forward, and it's not the same for everybody, and it's but that's just it. It's just a matter of taking a look at it, kind of lifting the hood, of the car, so to speak, taking a look at it, seeing where the problems are, seeing what can be fixed, and sometimes it's an engine rebuild, and sometimes it's a tranny, and sometimes you just got to fix a hose, So it's we never really know. Every situation is wildly different. It depends on how new, how old, how it was designed, what company it's with. We're seeing a lot of patterns with certain companies that are leading to some bigger challenges and bigger problems for big groups of people. And of course, those are leading to more litigation, so to speak. Yeah. And so,
there's been
but all that's going to come to the forefront soon enough.
Yeah, for sure. I think it's absolutely starting. Like I'm starting to see a snowball effect of these massive class action lawsuits coming out. I'm seeing a repeat pattern of like a repeated offense of these companies and these agencies selling these things. And it almost feels like I'm reading the same exact lawsuit that I did last week. It's a lot of them are involved or revolve around those proprietary or volatility controlled indexes, and just how unbelievably misrepresented they are. It's like just massive misleading marketing practices. And the reason I want to bring that up, guys, is not necessarily like the lawsuit aspect is not necessarily to say to not work with a company just because they have a lawsuit, but if you're potentially because people get sued for stuff all the time, and sometimes it's stupid, but sometimes there's a very good reason that these people are in lawsuits, because they deserve it. And if you are about to make a major financial decision in your life, you would, I would want to know if the company I'm about to do business with is in a major class action lawsuit for intentionally misleading, or I'm not going to say intentionally, but consumers on this product. And when you look at the lawsuit, I mean, it's like just so blatantly obvious. But that's an important thing to understand. If they're in a lawsuit for that particular reason, you should know that.
When you sell on half-truths, as we spoke before, like it effectively gets interpreted legally as a lie sometimes, right? Yeah. Because there's an element, it's called good faith, the good faith marketing, right? And so you're not acting in good faith when you sell on a half-truth. And that's something that comes into play. And this is what we're seeing a lot. And on top of that, you're seeing anytime these IUL agents are selling IUL as the tax-free income retirement vehicle or the rich man's Roth or an alternative to a 401k, they're not licensed to be making those statements. And in doing so, they're opening themselves up to legal problems. And if you're a person with a policy that is purchased from somebody on that sales concept, well, then you have a case. Like that's the reality.
Right. So anybody watching this, if you have an IUL and you're listening to this and you're concerned, which I certainly would be, make sure you go to rescue my IUL, right?
Yeah, rescuemyiul.com.
We'll link that down below. All right. It doesn't hurt to at least get an evaluation of it.
Yeah, totally.
Right? And see where you're at, run an in-force illustration, because that's going to tell you a lot about the future performance of the policy too. So make sure you take advantage of that. Chris, we'll go ahead and wrap up with that. I want to be respectful of your time. Really appreciate it. You know, if we don't cap the time on this, we could talk about this for hours. So,
we could literally go all day. Maybe we should sometime just go live and just wrap on it.
Just see how long we can go. So as always, I appreciate it, guys. Make sure you subscribe too, because Chris and I are going to be coming out with some really good stuff this year. We were talking at the Fast Start Forum about our pillars to success and how we combine different types of wealth building strategies and just the different stages of building wealth, you know, how life insurance, whole life insurance is incorporated into that. It's going to be awesome. So make sure you guys subscribe. But as always, Chris, I appreciate your time. It's always a pleasure, my friend. And I look forward to the next one.
Ditto. See you.
What's up, my fellow wealth creator? Thank you so much for checking out this clip from the Millennial Wealth Creator podcast. If you'd like to watch the full podcast, there will be a link down below in the description. Make sure to also check out the additional tools, training, resources that I have in the description as well, just to help you along your journey. Thanks again for checking out the clip, and we'll see you in the next one.